Revision for unrealized profits. In this edition of my podcast, I'm going to explain the basic principles and reasons why we make a provision for unrealized profit as a consolidation adjustment, and I'm going to place it in the SBR context. My name is Tom Clendon, and I help students pass their ACCA SBR accounting exams. And you can always reach me through my WhatsApp 07725 350 793. But look, this is about provision for unrealized profits, which adjustments do come up in the exam, and they should be low-hanging fruit. I want to start at the beginning. And the beginning is just to make sure you understand the fundamental principle of substance over form and faithful representation as applied to group accounts, as applied to the single entity concept. You see, we prepare the group accounts as if the group were a single entity. But it isn't. The parent is a separate legal entity who prepares its accounts, and the subsidiary is a second separate legal entity which prepares its accounts. But because the parent controls the sub, and if we want to understand the big picture of how all of those resources, how many resources are controlled and the returns on those resources, to understand that, to reflect the faithful representation that all of these resources are under a single control, even though there's two legal entities, we have to prepare the group accounts as if we think they are a single entity. So we use acquisition accounting, and we fully aggregate, we fully cross-cast all of the assets and liabilities of the sub, all of the income and expenses of the sub into the group accounts, even if they're only partially owned. Even if we only own 80% of the sub, we fully consolidate because we fully control all of their assets, all of their liabilities. So we have that full stewardship. We have that full accountability. And this explains why we have a non-controlling interest shown on the statement of financial position as part of equity. And this explains why, when we prepared our group profits in the P&L, we show the profits attributable to the parent and the profits attributable to the NCI. So the reason why we are doing a provision for unrealized profit ultimately comes down to the single entity concept, comes down to substance over form, truth over law, comes down to wanting a faithful representation, i.e. producing useful information. Right, okay. Now, I want to first of all talk to you about intra-company balances. Balances between the parent and the sub. And in order to do that, let me imagine that I've just borrowed $10,000 from my wife. Yeah? And therefore, in my accounts, I owe her $10,000. And in her accounts, she has an asset because she is owed $10,000. So our individual financial statements, I'm reporting a liability, she's reporting an asset. But in the marriage, in the marriage accounts, in the group accounts, there's no third party. There's no external asset or liability so far as the marriage is concerned. And therefore, in preparing the marriage accounts, the group accounts in other words, the intra-company balance of $10,000 would be eliminated on consolidation. Let me go one step further. Let's imagine she charges me interest, 10%. So over the year, she has an income of $1,000 and I have an expense of $1,000. She reports her income in her P&L. I report my expense in my P&L because we are separate legal entities. But in the marriage P&L, there's no income and there's no expenses because there's no external transaction going on. Yeah, you eliminated the intercompany loan and you would eliminate the intercompany interest and expense. Now, in the context of SBR, that means potentially you're adjusting a pre-populated spreadsheet. And if they haven't been eliminated, let's take the statement of financial position first. You've got to remove 10,000 from the bottom, 10,000 from the non-current liabilities, assuming it's a long term, and 10,000 from the asset, from the non-current asset. Yeah, you've got to remove them top and bottom. So it's a minus 10,000 from the top and a minus 10,000 from the bottom. So you're crediting the asset at the top, you're debiting the liability at the bottom, end of story. From the perspective of the P&L, I've got that finance cost in my financing section. So that's an adjustment of 1,000. I need to reduce the expense. I need to reduce the expense. So I would adjust it. I would adjust the minus expense by, in the adjustment column, adding 1,000 to make the minus expense a smaller number. And my wife would have had contributed in the investing section income of 1,000, which is a positive number. So adjustment there is minus 1,000 to eliminate that. So the 10,000 gets eliminated from the balance sheet, top and bottom, and the 1,000 gets eliminated twice from the P&L to eliminate the income and the expense. I'm getting there. I'm getting to the provision for unrealized profit. But before I get there, one more example to do with the sale of goods. And this time we're going to sell goods. The parent is going to sell goods to the sub for $2,000. Now what that means is if the parent has sold goods to the sub, by definition, the sub has bought goods from the parent for $2,000. And you know what I'm about to say. That's a transaction between the parent and the sub. That's a transaction which is eliminated on consolidation because it's intra-company, because we want to report the group as if the group is a single entity, no third parties involved, blah-de-blah-de-blah-de-blah-de-blah. And therefore, in your pre-populated spreadsheet, in your P&L, you're going to have to remove 2,000 from the revenue, debit. You're going to remove 2,000 from the revenue, minus is the adjustment, 2,000. And you're also going to have to remove 2,000 from the cost of sales because there hasn't been a purchase. The cost of sales is a minus number. So to make that minus number smaller, in the adjustment column, it's a positive 2,000 to make the negative adjustment. So you are debiting the revenue, 2,000, crediting the cost of sales, 2,000, sorted. You should be happy so far. And now I've laid the groundwork for us to be thinking about the provision for unrealized profit. Sometimes it's called a PUP, provision unrealized profit, or sometimes it's called a PUP, provision for unrealized profit, same thing. Now, same example, parent has sold goods to the sub for 2,000. But we're going to say now that they had cost the parent company only 1,500. They'd cost the parent company 1,500, but the parent had sold them to the sub for 2,000. In other words, they'd marked up the cost by a third. So they'd bought them for 1,500, added on a third, and sold them for 2,000. Or to put it another way, the gross profit margin, the gross profit percentage of sales is 25%. Because if you're selling it for 2,000 and the profit is 500 within that, that's 25% of the 2,000. So the markup is a third, the margin is 25%, markup on cost, margin on sales. Recap. The sale is for 2,000, but the parent only bought them for 1,500, and all of these goods remain unsold at the reporting date. Because if all of these goods remain unsold at the reporting date, we are going to have to make a further consolidation adjustment of 500. And we're doing that for two reasons. First of all, the parent has reported a profit of 500. The individual parent has reported a profit of 500. But in the context of the group, there's no profit. The group is not better off because of this transaction, because this transaction is effectively eliminated on consolidation. So problem number one is that profits need to come down because the profits are overstated. Problem number two is the subsidiary has inventory that it has bought for $2,000. As an individual company, it thinks it has bought goods for 2,000. But in a group context, the cost to the group, and we're preparing the group accounts, the cost of the group is only 1,500. So therefore, not only do the profits need to be reduced by 500 debit, but the asset of inventory needs to be reduced by 500 credit. And therefore, when we think about the statement of financial position and thinking about the pre-populated spreadsheet, the top half of the balance sheet comes down by 500 and the bottom half of the statement of financial position comes down by 500 by reducing the retained earnings. Sorted. Sorted from a balance sheet point of view. From a P&L point of view, if you've got a pre-populated P&L and you're making the provision for unrealized profit, you've got to make the profit smaller. To make the profit smaller, you increase the cost of sales. So we got an adjustment of 500 on the cost of sales. The cost of sales is a minus number. We need a bigger minus number, and therefore the adjustment is minus 500. And that is basically it. I mean, the parent has been the seller, so the profits attributable to the parent also need to come down by 500. There's no adjustment to the NCI because the parent was the seller. And we don't see the full double entry in the P&L. Yes, we've got the debit to cost of sales, increasing that minus number, but the double entry is to effectively an asset, and assets aren't in the P&L. Have I finished? No. There's a twist. In my example, the parent was the seller. In my example, the profits were reported by the parent, and we eliminated those profits by adjusting the group profits, the parent profits, without charge to the NCI. But if the sub was the seller, and it was, say, an 80% sub, then the adjustment to profits, the adjustment to retained earnings, the adjustments to profits would have to reflect 20% of that being charged to the NCI. So from the point of view of a statement of financial position, you'd still be taking 500 away from current assets, but in the bottom half of the balance sheet, 400 would go to retained earnings and 100 would be reducing the NCI. And in terms of the P&L, you'd still have the 500 increase the minus number on the cost of sales by 500, but the profits attributable to the parent would only come down by 400, and the profits attributable to the NCI would be effectively reduced by 100. Okay? Now bear in mind, we only make a provision for unrealized profit on the unsold stock. So if the sub has sold on the goods, the profit is then realized in a group context. Thank you so much for listening. I hope this has helped. You do have the ability to listen to this again. Yeah, you do, because I know sometimes I talk fairly fast. Yeah. Thank you for liking this podcast. Thank you for liking this and subscribing. My name is Tom Clendon. I'm here to help you pass your ACCA exams.